over 20 years. Because most people look at the EMI and feel the pain, but they never look at the total number. It is the kind of thing banks do not put on the front page of their brochure. A 53 lakh loan at 8.6% over 20 years. Your EMI is roughly 46,000. You will make 240 payments over 20 years. 240 multiplied by 46,000. That is 1 crore 10 lakhs. You borrowed 53 lakhs. You will return 1 crore 10 lakhs. The bank earns 57 lakhs from you, almost as much as you borrowed, just in interest. Your actual flat did not cost 65 lakhs. It cost, by the time the loan is closed, somewhere between 1 crore 20 and 1 crore 30 lakhs, depending on how your rate moves. Now, is that always a bad deal? No. If the asset appreciates faster than your interest cost, you come out ahead. That is the fundamental bet behind every property purchase. You are essentially saying, I believe this asset will grow faster than the money I am losing to interest. It is a reasonable bet. Sometimes it pays off spectacularly. But here is where my story starts getting uncomfortable.
You signed the papers on a Tuesday. The ink dried, the banker shook your hand. Your family called it a milestone. Your colleagues said you had finally arrived. And somewhere deep in your chest, beneath all the celebration, there was this quiet, specific feeling that you had just done something irreversible. You had. I bought a flat at 31, a 2 BHK in a mid-sized Indian city, in one of those projects that had a fancy name, a French word in the title, a brochure that looked like a luxury hotel catalog, and a possession date that was, according to the developer, absolutely confirmed for 24 months from the date of booking. I want to tell you what actually happened. Not as a cautionary tale, not to scare you off property, but because nobody told me the real math before I signed. And I think you deserve to see it before you do. Let us go back to the beginning. The year was 2016. India was in the middle of what every newspaper, every financial advisor, and every uncle at every wedding was calling a real estate revival. Property prices had corrected slightly after a few years of stagnation. Interest rates were coming down. The government was pushing housing for all. A new law called RERA was just around the corner, promising to clean up the sector. It felt like the stars were aligning. And I believed it. Completely. The flat was priced at 65 lakhs, all in. Or so they said. Registration, parking, club membership, power backup charges, maintenance deposit, and a mysterious line item called infrastructure development charges would eventually bring the real number closer to 78 lakhs. But in that first meeting, in that glass-walled sales office that smelled of fresh paint and ambition, the number was 65. I had about 12 lakhs saved. I took a home loan for 53 lakhs at 8.6% interest for 20 years. The EMI came out to roughly 46,000 rupees a month.
Month 7 of the project. Construction is visible. Slabs are being poured. You visit the site on a Sunday, stand behind the iron fence, take a photo, send it to the family WhatsApp group. People react with fire emojis. Your mother says it looks beautiful. It is, at this point, a concrete skeleton in the middle of a dusty field, but the excitement is real. Month 14. Progress has slowed. You call the developer's helpline. You are told there was some approvals pending, but everything is on track. Month 22. You email. No response for 3 weeks. When you finally get through, you are told possession will be delayed by 8 months. 8 months. You do the math. 8 more months of double payments. Rent plus EMI. That is 3,68,000 rupees in extra cost that nobody accounted for, nobody compensated you for, and nobody apologized for with any real seriousness. Month 31. Another delay. This time, 6 more months. The legal remedy available to you under RERA, which had now come into effect, was to file a complaint and claim interest on the delayed period at roughly the home loan rate. Which sounds fair until you realize the process takes another year. The developer has 40 other cases, and the payout If it comes in installments. And by then, you have spent time, energy, and some amount of legal fees chasing it. I got possession in month 41, 17 months late. I paid an extra 7 lakhs in rent during that period that I had not planned for. That is money that evaporated.
It bought me nothing. It is not sitting in any asset. It is just gone. Now, here is where the math gets truly brutal, and I want you to stay with me because this is the part that most people never calculate. When I finally moved in, the flat had theoretically appreciated. The developer's new launches in the same project were priced higher. Brokers told me my flat was now worth 82 lakhs. I had paid 65. That is a gain of 17 lakhs over 3.5 years. Sounds decent, right? Let us stress test that number. First, that 82 lakh figure is what brokers call the ask price, the price at which sellers list. The price at which deals actually close in resale markets, especially in mid-segment projects with developer inventory still unsold, is almost always lower, sometimes significantly lower. Second, during those same 3.5 years, a simple index fund tracking the Nifty 50 gave roughly 12% annualized returns. If I had invested my 12 lakh down payment and the difference I was paying each month between my actual outgo and what pure rent would have cost me, the numbers tell a very different story. Third, and this is the one that quietly broke my brain when I finally did this exercise, my interest payments over 3.5 years had already cost me approximately 15 lakhs. Just interest, not principal repayment, interest. Money that went to the bank and bought me exactly nothing in terms of ownership. So when someone says your flat went from 65 to 82 lakhs in value, the honest version of that sentence is, on paper, you gained 17 lakhs, while simultaneously writing a check to the bank for 15 lakhs in interest alone, losing 7 lakhs in unplanned rent, and tying up your capital in an illiquid asset through one of the more volatile periods in Indian real estate history. Your net position is not what the brochure suggests. There is a concept in finance called opportunity cost. It sounds like jargon. It is not. It is simply this. Every time you make a financial decision, there is a path not taken. And the cost of your decision includes not just what you paid, but what you gave up by not doing something else with that money. When I put 12 lakhs into a flat in 2016, I gave up the ability to invest that money elsewhere. I gave up flexibility. I gave up liquidity. I gave up the ability to move cities for a better job without the psychological weight of an EMI and an unsold flat following me everywhere. Those are real costs. They're just invisible on a balance sheet. The other invisible cost is what I would call the emotional tax of homeownership. Nobody warns you about this. The constant low-grade anxiety of a large loan, the helplessness of a delayed project, the sinking feeling when you visit a site and it looks exactly the same as 6 months ago, the nights you spend reading RERA forums and builder review websites, trying to determine if your developer is genuinely delayed or actually going under. That emotional bandwidth has a value. It costs you elsewhere. Your attention is finite. The mental energy spent worrying about this investment is mental energy not spent building skills, thinking creatively about your career, or simply being present in your actual life. I am not putting a number on that. I am just telling you it is real. Let us zoom out for a moment. India has approximately 1 crore unsold housing units as of recent estimates. 1 crore. That is not a rounding error. That is a structural oversupply problem that has been building for over a decade, concentrated heavily in the mid and premium segments, in cities where developers over-leveraged during the 2010 to 2015 boom and then found themselves unable to complete or sell inventory as demand cooled. Why does this matter to you as a buyer? Because price appreciation in real estate, unlike equities, is deeply local and deeply dependent on supply dynamics. A flat in a project with 300 unsold units in a micro-market where 5 other projects are launching simultaneously does not appreciate the same way a flat in a land-constrained, high-demand neighborhood does. Most buyers do not distinguish between these two realities. They hear real estate is a good investment as a universal truth, when it is actually a very location-specific, timing-specific, segment-specific claim. The guy who bought in South Mumbai in 2005 has a very different story than the guy who bought in a peripheral township outside Pune in 2014. Both of them bought real estate. Only one of them made money.
But it was not the good investment I thought it was. The returns, when you account for interest cost, opportunity cost, unplanned expenditure, and the illiquidity premium you effectively paid, were mediocre at best. A boring, diversified equity portfolio, maintained without any particular brilliance or timing, would likely have done better over the same period, with less stress and infinitely more flexibility. The flat did give me something: a home, a fixed address, stability, pride even. But I paid a premium for those things that I did not fully understand when I signed the papers. And that premium, if I had known its true size, might have made me think differently. Not necessarily decide differently, but think differently. Which brings me to the only question that really matters here. When you are sitting across from that banker, or that developer's sales representative, or that enthusiastic relative who owns 4 properties and considers himself an expert, and they are telling you that real estate always goes up, that renting is throwing money away, that this is the right time because it is always the right time, the question is not whether any of that is true. The question is whether you know enough to verify it yourself. Because they have something to gain from your signature on that paper, and you have the next 20 years on the line. Renting carries its own anxiety. Landlords who want the property back with 3 months' notice, children mid-school year having to move. The particular humiliation in an Indian family context of being a 40-year-old man who rents. These are real social and psychological costs on the other side of the ledger. Property also forces savings discipline in a way that pure investing sometimes does not. The EMI is non-negotiable. It comes out on the 5th of every month, whether you feel like it or not. Many people who think they would invest the difference if they rented simply do not. They spend it. The compulsory nature of a home loan has value for people who struggle with financial discipline. I understand all of this. I am holding both sides honestly. But I bought a flat because I was told it was a great investment. And on that specific claim, the numbers do not really support it. If what I wanted was a home, that is a different conversation with different criteria. But I walked into that sales office thinking I was going to make money. And I think a lot of people do. That is the confusion worth examining. A home and an investment are not the same thing. When you treat one as the other, you start making decisions for the wrong reasons and measuring outcomes by the wrong metrics. Here's the uncomfortable conclusion, and I want to be precise about it. Buying my flat was not the worst decision I ever made.
There is also the liquidity problem, which people systematically underestimate until the moment they need to sell. Selling a flat is not like selling a stock. You cannot exit in 5 minutes during a moment of market strength. The process from decision to closure routinely takes 6 to 18 months. You need to find a buyer willing to pay your price, negotiate, deal with home loan transfer paperwork, NOCs from the society, registration, capital gains tax calculations, and a broker who is taking 1 to 2% of the transaction value just for making some phone calls. If you bought with a home loan, which almost everyone does, the buyer's bank needs to be satisfied with the property's legal title. In older projects or projects with regulatory complications, this can become a genuine blocker. And if at any point during this process you need the money urgently, because life is unpredictable and people sometimes do need money urgently, you are in a very difficult position. You either sell at a distressed price or you do not sell at all. Real estate is what economists call an illiquid asset. That is not an insult, it is a category. Illiquid assets are not inherently bad, but they require you to hold them comfortably without needing that capital for the full duration of your intended holding period. How many people genuinely have that certainty over a 20-year loan horizon? Now, I want to be fair, because this is not a simple story of loss. I live in the flat today. It is comfortable. It is mine, or at least it will be mine in about 16 more years when the loan closes. My children have stability. My parents feel a certain cultural satisfaction that I own something solid and permanent. There is genuine value in those things that does not show up in a spreadsheet.